Remain Sisters Driving Transformational Change, moderated by Kevin Liu, Chairman of Asia and member of the Global Executive Board at Partners Group.
Thank you, everybody, for those who are staying either for the dessert or for this panel. I won't ask you for which reason you are still here today, but my name is Kevin Liu. I run the Asia business for Partners Group, a European private equity firm. We manage about $150 billion. I'm actually based in Singapore, but I do have the pleasure of coming to Hong Kong from time to time. I have the honor today to have two distinguished speakers with me for this sort of final sort of plenary session for the conference. And Tim is on the far end, is the CEO and CIO of Pennsylvania Municipal Retirement System. And Mark runs the strategy and risk management function for Mubadala, a sovereign wealth fund in UAE, right? I will let them later each to introduce their own organizations and their own role in more detail. So we were chatting before this, and we realized the three of us organizations are, while we are very different, and we do share one thing, is that we have the luxury of, we're all focusing on the long-term side of the investment, right? So, which means that most of the investment we do, certainly for Partners Group, we're pure play private markets. We don't worry about mark-to-market every hour and what's your P&L at the end of the day, right? And so I want to start there to ask my two panelists, how do they define long-term, and how do they see their investment activity related to the time horizon? So maybe I will start from Tim, right? So long-term, to me, as the investor, also means a little bit less bottom-up deal-making, a little bit more top-down allocation and policy. So for your organization, for the Pennsylvania Municipal Retirement System, Tim, how do you look at the sort of the top-down side, investment policy, allocation? What role do those play in your investment process?
All right, thank you, Kevin. So I think obviously long-term as an institutional investor for us is a 10-year horizon. So that's our first thing, but I think even before you even get there, we look at the fact that when we look at our portfolio, or just our entire portfolio, you know, we're guided around our investment policy, which we'll get into a little bit later, but our investment policy drives a lot of where we're going to seek diversification. And I think it's in that theory of diversification from a portfolio theory, which drives 90% of returns. So it's really diversification strategy, looking at a long-term horizon based on our return expectations to meet our return hurdle for, you know, our plan. And then the hard work is, after all that work, is then choosing and finding a manager that best represents stylistically what we're trying to achieve over that period of time. So that's a little bit on how we look at it from a top macro view. And happy to answer more questions later.
Great. Mark, maybe you can tell us a little bit more about what Mubadala is doing, and then obviously as a sovereign wealth fund with probably a lot of strategic ideas sort of in mind, you must be looking at decades of nation building, right? Tell us a little bit about Mubadala, and how do you look at the long-term topics dealing with the future of both your country and the world?
Thank you, Kevin, and good afternoon, everybody. For those of you who don't know Mubadala, we're a global investment company. We manage a portfolio north of 300 billion. It's globally diversified, and we run predominantly three different types of strategies. One that is a fund investment, where we work with top-tier GPs, invest in their funds. One, a direct strategy, where we take positions in companies. And one, a GP strategy, where we have homegrown GPs focusing either on private equity or lately in the AI space. Now, we're long-term, and we're very focused on private markets. Very similar to how Tim defined, our horizon is also 10 years and beyond. And the way we construct our portfolio, which is the first element of being long-term, is very much to align it to our conviction on that long-term. So we align our portfolio when we design it to a few trends that we see playing out that shape the future of nations, economies, businesses. And these are very much the 4Ds. The disruptive technologies and now AI. We've been deploying capital in that space since 2009, semiconductors, software, data centers, and. We align ourselves to demographics, all of the shifts that we see on aging population, on the new wealth, on the changing customer wants and needs, and we've been deploying capital in healthcare, new consumption, FS. The third D that we align ourselves to as well is a decarb and the shifts that are happening. This is a theme also we started betting on since 2006. Both on the renewable front, but also across the value chain, efficiency, effectiveness, water solutions. And the last one, which is becoming more and more important, is a deglobalization. Maybe not deglobalization, but the shifts in globalization patterns. Where on that front, emerging markets are growing. Asia is a very big angle, but you also have everything that has to do with supply chain, logistics, infrastructure, and so the long-term view that we take, that 10 years, that 20 years megatrend, we then construct our portfolio on a 10-year basis, on a 5-year basis, but where the ingredient actually comes is not only in deploying capital in these spaces, because we're not only a capital deployer, we're actually pretty direct and active in finding the deals, these great companies that are going to be the winners of tomorrow, these great partners that have the long-term view and are able to add value, and are very engaged both as a partner and a shareholder.
Great. I think you both talked about the long-term investing in a very different way, right? I think in a way that you represent two very different types of organization, right? Tim, I think the Pennsylvania retirement system is more allocator, right? Probably working with GPs, with help of consultants, deploying capital. And Mubadala obviously is probably a little bit more complex in terms of both the fund investment, direct investment, and anything in between, right? And while we enjoy the luxury, I use the word luxury in a slightly exaggerated fashion at the beginning, and as investors, we do have to react to a lot of short-term things, right? So this is not a parallel universe. You can say I'm a long-term investor. I make my policy, then I can go take a nap. That's not how it works, right? So I want to get both of your, again, from an allocator perspective and from a more sort of a multifaceted sovereign wealth fund perspective on some of those short-term things we are focusing on. You read about it on the papers every day, right? So maybe let's start with the obvious, the whole trade war, the whole concept of tariffs, which again, April 2nd seems to be a big date. It's not April 1st, at least now. People know that's serious. And so how do both of you look at that? How does let me rephrase it, right? So we have had very efficient globalization for decades now, right? It looks like the wind has changed. Looks like there will be speed bumps that are put into place, barriers will be put into place, such as tariffs. How do those things that you hear about it every day from the White House, from Mar-a-Lago, wherever that is, right? Tim, why don't you start? Does that affect your decision at all?
Well, if I may, let me kind of talk first within the organization and then talk about outside of our organization. So what we're talking about is risk. And the interesting thing is I was brought in 4 years ago because our public pension plan was having its own internal issues in terms of risk. And I was brought in specifically to help turn it around. Excuse me. That opportunity really kind of galvanized my trustees and allowed me to be able to say, let's start taking a look at our agency first internally to make sure we have the right team, our right executive team, to help manage sort of what it takes to be everything to our 20,000 or so members. So first of all, so that allowed us to then kind of create the right mindset and the right diligence inside our agency. We also, because of that, over 3 years ago already started de-risking our portfolio. So we did a big de-risking process that took somewhere around 51% of our assets, and we reallocated it. So we were able to kind of do those things. So now when you come into what always will be the unknown, the future, what could happen, our ability to look at sort of this risk in terms of both the real risk from executive orders and all the other things that are going, that are trading in the market, we're saying, where else could we sort of de-risk our portfolio and continue to drive performance? And in our analysis, we started looking at 2 new asset classes within PMRS. And to remind folks, PMRS is a 50-year-old public pension plan. So we started looking at both the private markets, and we started looking at within infrastructure and credit as a way to de-risk our portfolio even further. That provided, when we did an asset review, and that was just done recently, and we just went through education with our trustees, we saw that we can eliminate over 100 basis points of risk, and at the same time, we can gain 70 more basis points of return. That's a good deal. That's a good deal. That's a diversifier, and it's also allowing us to enter a new space, a new asset class that will allow us to be able to continue to meet the needs of our members long term. So that's sort of an answer from a very technical answer to your question, but I do think that on a day-to-day basis, I do pay attention, but we're not, as you say, we're not day traders. We're not retail investors. So I'm not sitting there looking at what the stock's trading at today. I'm looking at the long-term performance, and I look at 10, 5, and I look at 1. But our more attention is to our 10 and 5. So if we look at our performance, we just did another review. Our diversification strategy is paying off, because now on a 10 and a 5, we're actually outperforming our bench. And on a 1 month, we're outperforming the bench. So it's just diversification, and we do a quarterly review, and that's important to make sure that we are aligning with what we think in terms of our policy.
So Tim, what you're saying is that you're, to summarize, to paraphrase what you said, is that you use diversification as a risk management tool. That's your main response to these, sometimes news that slightly scare us or that create uncertainty, right? And Mark, do you see those uncertainties, such as tariff or trade war? Do you see that mainly as a risk? Do you agree with Tim? It's more about managing risk, or do you also see that as an opportunity? And how do Mubadala generally look at all these exciting news that are coming out on TV every day?
So let's look at these changes that are happening. The tariffs, Trump 2.0. But if you take a step back, a lot of these shocks started 5-10 years ago, and we're not yet over them. So with COVID shock, with all of the wars that happened, certainly the US election in 2024, but remember in 2024, 70 countries in the world had elections. That's half of the population of the world. Half of these elections, there were new leaders coming on board, with populations being unsatisfied with the previous leaders that want reforms. Add to this Trump 2.0 and all the shifts that we're seeing. This is a reality on the ground. And you can add to it inflation, populism, trade, tariffs. What that means for us as long-term investors is that the now actually matters. And we are in a stage where the volatility is a new norm, the uncertainty is a new norm. So how do we navigate all of this uncertainty? And here is how we do it at Mubadala. Number one, when we construct the portfolio, whereas in the past we would look at, call it 2 scenarios, a base case, a downside case, just to have a plan B, we cannot afford that binary view. The scenarios, one, are not that obvious, so we look at 5, 10 scenarios. When we construct the portfolio, it's not on a base case, and if something happens, a plan B. We need that portfolio to be able to be resilient under all types of scenarios and be dynamic, that we adjust as we go. That means a couple of things. From a risk analysis perspective, from a portfolio analysis perspective, understanding better what's happening in the world, factor analysis, managing the portfolio, dynamic asset allocation become extremely important. The second fold is also on the investment itself. And here we notice that maybe our toolkit that we use in the past, over the past 5 or 10 years, is not necessarily well suited for the next 5 and 10 years. What does that mean? We need to understand a much more complex world: diligence, underwriting, risk management, regulatory changes. All of that is becoming much, much more important so that we can operate, protect the portfolio, protect the investment. Why? To be able to tap into the opportunity and create that value. And interestingly, this is where tools like AI can be extremely beneficial. And we've been experimenting over the past 2 years, internally developing our solutions, working with partners to find the right solutions to be able to be more aware, more disciplined, better informed across the entire investment life cycle. The third thing that is also a very important ingredient, and touch on it, diversification remains a cornerstone of building a resilient portfolio to be able to tap into the opportunity. But in that uncertain world, partnership, collaboration becomes even more important, because nobody can actually do everything themselves, particularly when you are long-term. You don't want to take the risk fully, and you know that you cannot bring the full value to the table, and collaboration actually helps you do this. So these are the 3 things that we calibrate ourselves to be resilient and tap into the opportunities.
Yeah, I think a couple of things both Tim and Mark mentioned certainly resonate with me, right? So I think as an investor, I think the importance of diversification is paramount, right? So so Partners Group manage probably over 900 institutional investors' capital, right? Many of them, actually over a third of our portfolio, we customize our portfolio for them rather than just channeling their money into one particular fund. In that process of customization, diversification is a big topic, right? It doesn't matter today which strategy happens to be hot. You can look at the track record. Track record is always a qualified concept, right? I think, but diversification, well-designed, well-constructed portfolio, which introduce several dimensions of diversification, almost always serve you in a good way. So for Partners Group, again, as our own sort of experience, right? We have been managing 4 different private market asset classes for over 2 decades, right? It's private equity, infra, private credit, and real estate. And in our search for diversification, and last year we were looking for risks that are return that are not as correlated with those 4. And we decided to launch this royalty strategy, where I look at the pharmaceutical, music royalty, and because we see an emerging asset class that offers that a good risk return, and it's sort of fixed income-like, but has equity return. But an even bigger reason is what we just discussed, is really diversify you away, right? So Tim, are you guys looking at new things? What are the most exciting 1 or 2 new things you are looking at to diversify your portfolio?
Thank you, because as I listen to the colleagues here, I just want to kind of level set. So we are a very complex plan in a sense that when you think about 900 LPs, you say, I have 1,060 LPs. I'm one of the largest OCIOs, but I happen to be a statute by the state that manages pension plans for these employers across the Commonwealth of PA. If you think about it, the first thing I did when I came in 5 years ago is I looked at the marketplace. I don't think most government folks say marketplace, but we have a third of the market in the Commonwealth of PA, and we're open competition. So our plans readily join or drop based on what we do in terms of our performance and our ability to administer their pension plans. We administer the liability as well as we invest the assets. So it's a very complicated business. And if you think about what that means, we have plans that are very small. These are primarily police officers and firefighters, but there could be authorities, which is a unique structure in the Commonwealth or in the United States. These plans would not have been able to withstand the impact of 22 in the way that they would as a single standalone as opposed to pooled with us. And that's because of the broad diversification strategy. So what does that look like? So we have equities, but we have U.S. equities, we have international, right? We also have a core plus strategy, so we also have some index. We also own timber. We own real estate, direct holdings. We own in fund structure real estate. So it provides, and then we have our fixed income. And in our fixed income, we have an ag, we have a core strategy, and we have a high yield strategy. At any given time, right, one of these strategies is outperforming, right, and the others are maybe not performing as well. But we're not worried. We're worried about the overall net effect over a period of time. And that's where I think this concept is constantly, I heard this morning, we're talking about diversification. We're still talking about diversification. I think everyone in the room understands the value of diversification. But I think what's important in the landscape of us to our services to our members is they would be in such a much worse position if they had a standard portfolio and tried to be able to come back in terms of where we've been able to position them. So why? We're over 100% funded. We're over 104% funded right now as a public pension plan. There are not many public pension plans in America that can say they're over 100% funded. And I think the fact that we were able to go through 22, have the market downturn, we de-risked, so we lowered our beta so that we can say, okay, we're going to capture less of that downturn. We're not trying to capture all the upside. That's not our goal. And so that has allowed us to then say, okay, when the market rebounds, it's going to be maybe our forest. It's going to be maybe some of our, won't maybe real estate, but it could be our high yield outperformed. High yield was doing great during the cycles of the credit raise. And so we know that this year, it's not going to be the same. High yield is not going to be performing at the same level. So it's going to be the other areas of our pension plan. And that's really what I talk about when I talk about diversification, is the fact that our managers and our asset selections are allowing us to be able to, to get the yield that we're looking for in terms of our overall plan. So that's a little bit of.
And Mark, same question to you. In your wide range of activities, investment activities by Mubadala, what are the one or two things that you are most excited about, whether it's for diversification or it's a search of new asset class, anything that sort of occupy your brain at this point?
Listen, certainly a lot of the asset class play a role of diversification. And we're very bullish on, call it infrastructure, on private credit. On the long term and through the cycle, they add a lot of diversification to the portfolio, but more importantly, we believe in the fundamentals as opposed to only the diversification element. On diversification, a couple of thoughts. The correlation or the normal correlation of the past are also changing between asset classes, between regions, and constructing a portfolio that is resilient, they need to take into account all of these changes and correlations. But if you look at, for us as direct investors, single transactions, the broad risk return or profiles of an asset class does not necessarily translate into the single investment. And sometimes, we did a lot of investment at the peak in the 2000 and 2001. Actually, a lot of these turned out to be much more resilient than the broad asset class because they were the right companies set up for the future, very diligent, very disciplined, and came out from this correction in a much better and winning situation. So going forward, we look at the sector fundamentals, the regional fundamentals, because we're taking a very nuanced between what's good in the US, what's good in Europe, what's good in Asia, what's good in our part of the world, and factor all that in instead of looking at broad asset class behaviors.
Great. We touched upon a few sort of short-term uncertainties, right? Geopolitics included, tariff, trade war. But in the longer term, in your view, both as investors, what risk really worry you, what you don't, in terms of longer-term risk, right? Rather than short-term.
Well, I know there's always going to be something. So what risk am I worried about is the risk I don't know about, right? How do I plan for that? I can't. But what I know is that the risk we're looking at today may not be the same risk that's going to be there tomorrow. So if you just try to react to today, it's not going to really position you against tomorrow, because tomorrow could be another thing. I can give you an example. The wildfires that were happening in LA. If you heard about those wildfires, I mean, it was horrible. And it actually caused this shift in the thinking of climate warming, in a sense that water was not available. Water was not available to fight devastating fires. That was an infrastructure issue. You had wind, and the other part was you can't predict 190 mile an hour gusts that are blowing embers across a dry bed. These are things they never factor. And California has one of the best early management systems in the world. People come to study what they do, and they couldn't get it right. This is the point. They could not get it right. And this is millions of dollars. So I think from my standpoint is we have to remain, and we do remain vigilant. I think it's the vigilance factor, the fact that you know something is going to happen, and keeping your team on top of its toes, that to say, don't get complacent. I'm here in Hong Kong because I refuse to be complacent. I want to come here. I'm here to learn. I've been hearing tremendous things, and I could take that back, and that'll inform me, especially when I sit with a manager who then tells me like what they see the view. That's just a sense of how this wraps up for someone like me.
Right, so what you're saying is that in addition to look at specific risks, think about them, but also have that mindset that there are things we don't know, and we will not know deterministically, and therefore have that curiosity, have that ability to react to new risks as they emerge. I think that's absolutely important. And Mark, what long-term risk do you worry or not worry about?
Listen, very much like Tim, we worry about many things, but we cannot be sure or forecast how these play out. So for us, it's staying risk on. At the end of the day, you cannot make money or shape the world or participate in that transformation by sitting on the sideline. But at the same time, you don't put all your bets in 1 year. So staying consistent, deploying to the cycle, being dynamic, like Tim said, to adjust, calibrate, navigate, and be active. But the interesting thing, and I'm going to pick on Tim's example of the wildfires, all of the risks that we talk about are also associated with opportunities. They're a second side of the medal of any of these risks. So let's take a few of them. They are worrisome if you look at the half-empty glass, or they can be quite optimistic and hopeful. Take AI, for example, which could help solve a lot of the challenges that Tim was referring to: disaster recovery, healthcare, cure, access to education, care, a lot of very big challenges that our world is facing today and that is needed in the future. Now, in AI, we're very early on in the build-up phase. We're not yet at that transformational phase where all the companies are adopting, understand it, and this is where we're going to see the real transformation. As a matter of fact, there's, give or take, 7,000 new data centers that are being built or planned to be built between now and 2030. Put that in perspective. That's 2 times all of the data centers that were built over the past 15 to 20 years. In a quarter of the time. Climate risk is massive, so power AI, the workload, the data centers, EV, electrify the grid, electrify industries, address climate change, and add all the risks that you mentioned, all of that can be weighing very heavy. But for us, we see that as where the world is heading, and we want to participate in helping transform that world into a better place. So we look at the opportunity side of it.
And you two both obviously came outside from the region, and we were chatting a little bit before we came into this room about what you have seen and observed here in Asia. So how do you as a very classical U.S. pension team, and Mark as a very classical, I would say, Middle Eastern sovereign wealth fund, how do you look at Asia in your portfolio, or more broadly, right? I mean, we were chatting about the high-speed railway from Hong Kong to Shenzhen, which is now, 15, 16 minutes, right? Which is, that was the trip used to be 2+ hours of car ride, right? So things like this, how do you look at those sort of newer phenomena that's happening in Asia? How do you relate that to your investment portfolio or your general strategic thinking?
Yeah.
From your different angles, obviously. Yeah.
Well, thank you. Well, as I mentioned, we're going to go through the process now in looking at private infrastructure managers. And it's a concept that we're thinking globally about. So I'm informed in terms of my presence. You know, I spent yesterday, I think I shared with you, I walked 5 miles just walking through Hong Kong, and just the people, the dynamic, the fact, it's just so many things that the goodness you could see there in terms of people. I think that's one element. The other thing is, in terms of infrastructure, I look at how many projects, whether, I don't know if they were just new in a greenfield or if they're maintenance, but you just look at how much is being developed. So it informs me, you know, I know the world's big. There are times where you get all your information fed to you from newspapers or trade magazines or your managers, but that doesn't do enough to give you how dynamic things are. You cannot see what's dynamic. You can't get a sense of that unless you're there. And I think that's what I look for, is I get that sense of the factors that you just can't account for when you just read a document, and once it's printed, it's probably already old. When I get it, it's probably already weeks old or something. So I think that's the element I see. And I don't want to add a new subject, but I just want to add to what was said, is that, you know, when I think of technology, right, I'm an engineer background, the one thing we used to write a code, and it constantly spits out the same thing. That's the idea, right? It never makes a mistake. There's some factors, you get the numbers. But the most dynamic part is human behavior. It's the human behavior quotient. That's the part that we just don't know that's going to show up. So I just want to add that with that.
That's a great point. Yeah, it's hard to quantify. You have to, I think one of the earlier points Mark mentioned, right? The long-term relationship actually adds a little bit of that, because, right, you can have a little bit of predictability about behavior. Other than that, it's very hard to conceptually say, you know, good or bad, right? So Mark, what do you think? I mean, Mubadala obviously famously has a very big China team. And I forgot the number, if you can tell us, it's 40, it's 50, right? A lot of a very strong team in China, which shows you do have a level of interest, right? But in general, for Asia, how does Mubadala look at Asia?
We have strong convictions for Asia. We just look at the fundamentals. More than half of the population, demographics is massive, growing wealth. Look at where monetary and fiscal policies are. Look at where inflation is compared to the developed world. Low inflation, higher inflations. Look at the means that Asia has and all the reforms that came over the past 3-4 years, the build-out, the educated population. So it has a lot of tailwinds that we have recognized for a while. We have started deploying capital in China since 2015, and actually stayed invested in China at the time when a lot of the Western firms pulled out of China, and have been accelerating deployment pan-Asia. India is very attractive. We've been putting a lot of money there. Japan, South Korea, and beyond. And you have thematics that are very interesting, a lot that I already mentioned. So we're very interested, very bullish Asia.
Great. In this very, very complex world, you know, as also Tim sort of briefly touched upon, right? I think the ability to react to surprises, whether it's risk you don't know, the opportunity you didn't see before, is incredibly important. I think we don't only have 2 or 3 minutes left, so maybe each of you, what changes are you anticipating in your, whether it's portfolio or thinking, what's like one thing you plan to do you didn't do before?
Mark?
Listen, for us, we stay focused on the long term. We like to be consistent, so consistency is very important. Avoiding knee-jerk reactions for us is very important, but becoming more sophisticated is what we're focusing on.
Tim?
Yeah, I smile because, it's very dry. Because if you want to be vigilant and diligent, you have to enjoy the small, micro, little things you do constantly to stay vigilant. I find joy in it. So the thing here is we just have to continue to do the things I talked about, which is we don't know what the next thing is going to be, but you want to just be, from a positioning standpoint, thinking about your portfolio and positioning it. We've decided to enter 2 new asset classes already, and there's not going to be a magic wand, but over the next several months, I have already laid out the process for being able to go through and finding those managers. That's the work. That's the job. That's it.
That's great. So I would just conclude by saying, as I'm based in Singapore, right, the Partners Group have 700 people in Asia. For us, we're always here trying to pick up those data points, but it's always great to welcome guests from the US, Middle East, or elsewhere, global investors come in to compare notes, because that's also how we also learn from the other regions. What are you thinking about, and how Asia can be connected with whatever you have in mind. Great. With that, let's conclude this session. I think this is the last plenary session. I wish you all a great afternoon. Thank you very much, both.
Thank you.
Thank you very much.
Thank you for attending the Milken Institute Global Investors Symposium. We hope you found your time and